Hey, Bill Ackman, a billionaire and top value investor, recently shared his 5 key principles for successful stock market investing in an interview. You need to hear what he's about to say because it's almost guaranteed to make you a better investor and help you make more money. So let's dive in! Bill Ackman currently manages almost $11 billion invested in 7 stocks. In a recent interview on the Lex Fridman podcast, he explained his investing process in a clear, easy to understand way. His investment approach is based on 5 key principles, with the first one focusing on the difference between price and value.
In your lecture on the basics of finance and investing, you mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. So important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets, World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value, right? Price is what you pay. Value is what you get. And he said the stock market is here to serve you, right? And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. He talked about the difference between, he said the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something's worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is it's a bit like trading crypto, right?
Strong words.
Well, short-term trading crypto. Maybe in the long run, there's intrinsic value. But it's many investors, in a bubble going into the crash, were really just pure speculators. They didn't know what things were worth. They just knew they were going up, right? That's speculation.
This is how things usually go. Many people see Booking stock price at $4,200 and think it's more expensive than Airbnb stocks at $150. This is not investing because just looking at the stock price or comparing 2 companies' prices doesn't show you which one is expensive or not. To know if a stock is expensive, you need to compare it with your estimated value of the stock. If after your research, you estimate that Booking stocks is worth $8,000, but it's only priced at $4,200, then the stock is cheap and undervalued. If you estimate that Airbnb stocks is worth $70, but it's selling for $150, then the stock is expensive and overvalued. Once you know the value of the stock you want to buy, you are in a good position to take advantage of the market fluctuations. For every person buying a stock, there is someone selling it. In the short term, a stock's price is often influenced by the emotions of sellers and buyers. In the long run, as Warren Buffett famously said, if a business does well, the stock eventually follows. If you buy wonderful companies for less than they are worth and keep them long term, you put the odds in your favor of making money by taking advantage of those inefficiencies. As an investor, your main job is to figure out the value of a stock. If you are not experienced in valuing a company, you might be asking, okay, Frenchie, this makes sense, but how do I value a company? Let's hear what Ackman has to say about this.
Investing is, doing your homework, digging down, understanding a business, understanding the competitive dynamics of an industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. But it's, so investing is about basically building a model of what this business is going to produce over its lifetime.
So how do you get to that? This idea of called value investing, how do you get to the value of a thing? Even like philosophically, value of anything really, but we can just talk about the things that are on the stock market,
Sure.
companies.
The value of a security, the value is the present value of the cash you can take out of it over its life. So if you think about a bond, pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a US government bond, you know you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict the future. So what we do for a living, what I do for a living, is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
As an investor, the key question you are trying to answer when valuing a business is what amount should I invest today for the money I'll get in the future based on my assumptions on the estimated performance of the business. Your job is to picture a company's future value, then to figure out what that value is worth today based on the money you want to make from owning this stock. You start by asking yourself, if the company's profit grows by X% each year for the next 10 years, how much can I expect to sell the business for in 2034, assuming it's 2024? The X% growth you estimate is based on your understanding of the business, its competitive advantage, and the management team's ability to use that advantage. Once you estimate the business earnings in 2034, you apply the multiple you believe the business could be sold for. Businesses are usually sold based on the multiple of their earnings. If your favorite kebab shop makes $10,000 in annual profit and you want to buy it, the owner might agree to sell it for 10 times its earnings, which would be $100,000. This multiple is called the price to earnings ratio, or PE ratio. Once you estimate how much you could sell the business for in 10 years, you work backward to find its current value based on the annual return you want each year from the stock. Let's use a lemonade stand and calculate its value. Let's assume that the lemonade stand has earnings per share of $10. Earnings per share, or EPS, is the company's total earnings divided by the number of shares available for the public to buy. The lemonade stand earns $1,000 per year and has 100 shares, so its EPS is $10. You know the lemonade stand is in a great location, near a sports center, and a second sports center is opening soon, which will drive up lemonade demand. You are also aware that the owners make such great lemonade that people travel from 10 kilometers away to buy it. All this makes you believe that the lemonade stand has a strong, durable competitive advantage and can sustain a 10% earnings growth each year for the next 10 years. This leads you to an EPS of about $26 per share in 2034. The next question is how many times its profit the lemonade stand could be sold for in 2034. In the stock market, there is a long-standing relationship between a company's growth rate and its price to earning ratio. For public companies, those usually end up being roughly double. Twice the growth rate is usually a good estimate for the PE ratio, so you apply a 20 PE ratio, which is your 10% growth rate multiplied by 2, and this gives you a future stock price of about $520 for the lemonade stand in 2034. You then ask yourself, how much should I pay for the stock today to get a 15% return each year, assuming the stock price will be about $520 in 2034. This is what we call the minimum acceptable rate of return, or the MAR. It's how much annual return you require for every year your money is tied up in this investment. Applying a 15% MAR to the $520 stock price in 2034 gives you an estimated value of about $130 per share in 2024. You won't buy the lemonade stand at this price because you need to account for potential mistakes in your analysis and protect yourself. Every market valuation is just a number from today multiplied by a story about tomorrow, and sometimes your story might be wrong. This brings us to the third tenet of Bill Ackman, which is the margin of safety.
You can't get to a precise view of value. You can get to an approximation. And the key is to buy at a price that represents a big discount to that approximation. And that gets back to Ben Graham. Ben Graham was about what he invented this concept of margin of safety, right? You want to buy a company at a price that if you're wrong about what you think it's worth, and it turns out to be worth 30% less, you paid a deep enough discount to your estimate that you're still okay. It's about investing. A big part of investing is not losing money. If you can avoid losing money and then have a few great hits, you can do very, very well over time.
Paying a price that provides you a huge margin of safety is the key to surviving in the stock market. If we go back to the example of the lemonade stand, you wouldn't buy its stocks at about $130 in 2024 based on your estimation of its value. You will buy it at half the price, around $65, giving you a 50% margin of safety. This provides a buffer to protect you from losing money if your assumption about the company's value is wrong. The reason it's key to buy a stock at a price that protects you from losing money is because your losses have a bigger impact on your portfolio than your wins. If you buy a stock at $100 and it falls by 50%, you are left with $50, and to get back to your $100 from $50, you need the 100% gain. The best quote that highlights the concept of margin of safety is from Warren Buffett, the best investor in the world. When you build a bridge, you insist that it can carry 30,000 pounds, but you only drive 10,000 pound trucks across it. And that same principle works in investing. I recently made a video about Buffett's best quotes, and if you are interested about it, you can find it in the description. To nail your estimate of the company's future value, you need to clearly understand the factors that will influence its growth rate. This is the fourth point of Bill Ackman.
What are the factors that indicate that a company is going to be something that's going to make a lot of money, it's going to have a lot of value, and it's going to be reliable over a long period of time? And what is your process of figuring out whether a company is or isn't that?
So every consumer has a view on different brands and different companies. And, what we look for are sort of these non-disruptible businesses, a business where you can kind of close your eyes, stock market shuts for a decade, and you know that 10 years from now, it's going to be a more valuable, more profitable company.
The key to finding a non-disruptable business is the company's competitive advantage. To find the company's competitive advantage, put yourself in the shoes of a customer and ask why they choose company A instead of company B to solve their problem. For example, if a customer shops at Lidl or Aldi instead of Whole Foods in the US, Harris Farm in Australia, or Waitrose in the UK, you might conclude that this customer buys at Lidl or Aldi because he wants to eat cheaply as opposed to eat qualitatively. So this customer chooses Lidl or Aldi because they offer the best value for money for the items he needs compared to other stores. To project those companies' earnings growth for the next 10 years, you will then ask yourself, how durable is their competitive advantage? You might conclude that Lidl and Aldi are so big that they have significant bargaining power with suppliers, allowing them to get products cheaper and sell them at lower prices than their competitors. This conclusion will then support the earnings growth potential you believe they can achieve over the next 10 years. At this stage, you might be thinking how you could buy a wonderful company with a durable competitive advantage for 50% less than its value. Other investors are not likely to offer deals like that. This leads us to Ackman's fifth principle about market inefficiencies. He explains through his investment in Chipotle, the largest stock in his portfolio, how to find great companies for less than their worth.
So in the case of Chipotle, for example, by the way, I could talk about Chipotle all day. I just love it. I love it. I wish there was a sponsor.
I'll mention it to the CEO.
Don't make promises you can't keep, Bill.
I'm not making it.
All right.
Brian Nichols is a fantastic CEO. He's not going to spend $1 that he doesn't think is in the company's best interest.
All right. All I want is free Chipotle. Come on now. What was I saying? Oh, and so you look at a company like Chipotle, and then you see there's a difficult moment in its history, like you said, that there was a food safety issue, and then you say, okay, well, I see a path where we can fix this, and therefore, even though the price is low, we can get it to where the price goes up to its value.
So the kind of business we're looking for is sort of the kind of business everyone should be looking for, right? A great business. It's got a long-term trajectory of growth out into the even beyond the foreseeable distance, right? Those are the kind of businesses you want to own. You want businesses that generate a lot of cash. You want businesses you can easily understand. You want businesses with these sort of huge barriers to entry where it's difficult for others to compete. You want companies that don't have to constantly raise capital. And these are some of the great businesses of the world. But people have figured out that those are the great businesses. So the problem is those companies tend to have very high stock prices, and the value is generally built into the price you have to pay for the business. So we can't earn the kind of returns we want to earn for investors by paying a really high price. Price matters a lot. You can buy the best business in the world, and if you overpay, you're not going to earn particularly attractive returns. So we get involved in cases where a great business has kind of made a big mistake, or you've a company that's kind of lost its way, but it's recoverable. And we buy from shareholders who are disappointed, who've lost confidence, selling at a low price relative to what it's worth if fixed, and then we try to be helpful in fixing the company.
To make money in the stock market, you need to become good at spotting those inefficiencies and taking advantage of them. They do exist, and the market offers them if you are patient and ready to invest aggressively when they show up. If you had invested $10,000 in Chipotle when Ackman bought it in 2016, your investment would be worth $65,000 today, which is an amazing investment return in 8 years. This is it for today, guys. If you like this video, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out.